So you want a perfect retirement. What's the secret? This is Matt Kennedy from the Presley Group. Coming up on Your Money Matters, 10 steps to a perfect retirement. Plus, we'll hear from Mark Hulbert from the Hulbert Financial Digest and MarketWatch.com. Coming up on this edition of Your Money Matters, presented by the Presley Group.
And welcome back to Your Money Matters, your weekly peek inside the complex financial world. You listen to the show so you can retire with peace of mind. And what better people to tell you about that than Christy Smith, president of the Presley Group, and Matt Kennedy. Christy and Matt are experts at helping you plan for a successful retirement. They teach their clients how to position their retirement money to avoid losses due to stock market conditions. They have helped hundreds of clients achieve their retirement goals, and they can help you. Here are your hosts for Your Money Matters, Matt Kennedy and Christy Smith.
Good morning and welcome to Your Money Matters, brought to you by the Presley Group. I'm your host, Christy Smith, joined in studio this morning with my co-host, Matt Kennedy. Good morning, Matt.
Good morning. Had that rain come through, and boy, it's going to be a beautiful weekend. Cooler weather, loving it. Gorgeous weather.
Good weather for rodeoing, huh?
Good weather for rodeo. And so Presley's running this weekend?
Yeah, she's running in Bastrop for junior high rodeo. And she's actually running a new horse. You know, the funny thing is, Matt, we've been watching the Olympics for the last couple of weeks. Mm-hmm. And, you know, her dream ultimately would be to ride in the Olympics one day. And she said, Mom, she said, what if all of these Olympians had to go through the things that we have to go through with our horses? You know, you've got a big competition on Friday and your horse gets hurt on Tuesday, and all of a sudden you're scrambling to figure out what you're going to do. And, you know, I had to talk to her and explain to her that, in fact, they do go through those types of situations as well.
Oh, yeah.
And it's been a good lesson for her. I'll tell you, I've really enjoyed the last couple of weeks watching the Olympics.
It's been great. And, you know, the Olympics are all about what? Trying to be the absolute best in the world.
Yes.
There's like, what, 7 billion people in the world?
Do you find yourself watching for them to flash the medal count on the screen?
Oh, yeah.
Just to see how we stack up.
But you're watching the Olympics, and what you're watching is you're watching people strive for perfection.
Yes.
I mean, no one is perfect. But to be a great Olympian, to be a great champion, to be a great barrel racer, you got to be almost perfect, right?
Yes.
So I ran across an article that was written by Paul Merriman. He writes for MarketWatch.com, and he has a great article called 10 Steps to a Perfect Retirement.
A perfect retirement. Listen to that word.
What would your perfect retirement be? I already know what mine would be.
My perfect retirement would be not to have to worry about income.
Okay.
And to be able to enjoy life, enjoy my family, and you know, and just not to have to worry. I always say that a perfect life, a perfect retirement is going to look like a picture in a picture frame. Because,
you're right.
You're always smiling in that picture frame and there's no worries
it's
there.
All perfect.
And it looks perfect. And so to me, retirement is going to look like a perfect picture in a picture frame.
I'll get much more detailed. This is my perfect retirement, okay? And my wife and I have talked about this since the day we got married 20 and a half years ago. Oh, by the way, happy birthday, honey. My wife's birthday is Monday. She's 39.
Don't say it.
She's 39. But we always dreamed about having an incredible bed and breakfast like in the Smoky Mountains or the Rocky Mountains. And we run that. And so that becomes a source of retirement income for us, you know, because my wife, as you know, is an amazing cook.
Yes.
And my brother-in-law can handle all the handyman chores because I can't. But we've dreamed about that. So Paul writes, there are really 10 steps to a perfect retirement. So let's go through some of these. Number 1, know how much money you're going to need to retire. That sounds so simple. It sounds almost overly simplistic. But he writes, the number is a key that helps unlock some mysteries, such as how much risk you should take and when you'll be able to retire. And he says, here's how you figure it out. Figure out your essential basic living cost, the rock bottom amount of monthly cash flow you need to sustain you. Only you can figure out this number. And Christy, I got to tell you, you and I know, do this every day of the week as we meet with people who come in to see us at the Presley Group. One of the questions I always ask is, How much do you need to live? Not to enjoy, but just to meet your basic needs.
And Matt, you would be very surprised at how many people don't know that number.
They have no clue.
You know, I always go back to the commercial on TV where Fidelity would advertise, what's your number?
I think it was ING, actually.
ING, what's your number?
Yeah, they had the big orange number
Yes,
people walked around
yes.
with. But remember, that was, if I'm not mistaken, that was either right at or right before 2008.
Right.
And all that mattered was, how big is your number? By the way, trivia question for you. What's the lowest number they ever showed in those TV commercials? You know, people would walk around with $1 million or $2 million. What's the lowest number they ever showed?
I'm going to guess 2 million.
642,000. That's
Wow.
the smallest number they ever showed. Many Americans don't have nearly that
No,
much
they
saved.
don't.
But the fundamental mindset now is not how big is my number, but what is it, Christy?
How
long
much
is
income?
How long is my number going to last?
Yes.
And so Paul writes, you have to compute the gap between what your basic needs are and what Social Security and pensions will provide. Then you have to come up with a plan to make up the gap.
So, for example, if your investments are worth $500,000 and you need about $30,000 a year from them, that's going to give you a withdrawal rate of about 6%.
Very aggressive.
You know, and so that lets you know that you probably need to save a little more before retirement because 6% is an aggressive number.
You know what the recommendation is? 25 times your annual income when
Yeah.
you retire.
Yeah, 25 times your annual income as a rule of thumb. You're
I
right
mean-
about that.
I mean,
and you would, most people don't have that, Matt.
No, but if you need $30,000 a year, now again, we have to keep in mind many people will have some of that $30,000 met through Social Security. But if you need $30,000, then the rule of thumb is that you should have $750,000 saved up. Not to make you feel
Wow.
bad, but that's the rule of thumb. Okay, number 2 plays right into this. The number 2 step to a perfect retirement. So number 1 is determining what your rock bottom expenses are going to be. Know how much you'll need for the retirement you would like.
And that's a lot different than how much you actually need, Matt. You know, when we think about how much we need, we really only think about paying the bills. You know, we think about keeping the lights on, the insurance on the home and vehicles, things like that. But when we think about retirement, we need to really consider how much do we need to live the life we want. We're not retiring at 60 years old and sitting on the front porch rocking, the life away anymore, like my grandmother did. Okay, we're traveling, we're playing golf, we're doing a lot of things with our grandchildren. We see a lot of our retiring clients actually buy new homes in their 60s now.
I think there's a misconception that, when I retire, I'm going to spend a lot less money.
That is definitely a misconception.
And one thing I've learned in 6 years of working with you, Christy, while a lot of people may end up spending less money once they're older and their health slows them down, in the first 5 to 10 years of retirement, you're free. For the first time ever, there's no boss to say you have to be here at this time and leave at that time. Now you're free to go, and going can mean spending more money, and that can mean you've got to have guaranteed income.
You're right, Matt, because 60 today is the old 40. And so we do have to worry about spending more money at first in our early years of
Yep.
retirement. We have got a great book today called The Proper Use of an Annuity in a Retirement Income Portfolio. It's an annuity owner manual. Give us a call today and let us mail you out this very valuable brochure, The Proper Use of an Annuity in a Retirement Income Portfolio. Our phone number is 791-5773. 791-5773. Because Matt, really, ultimately, the things we've already discussed all lead us to making sure we have enough money to live on during retirement, and our products, the tools we use, can help our clients accomplish their dreams.
Absolutely. So step number 1 is know how much you'll need to retire. And Christy, I'll argue that may be the hardest step.
I think it is.
Most people put off going to the doctor. Why? Because they're afraid they'll find out something's wrong with them.
Right.
I contend that most people in their 50s put off talking about retirement because they're afraid they'll find out they haven't saved enough and there's no hope for them.
Well, and I think another issue is that people really want their cake and eat it too.
Yeah,
they
that's
want
true.
maximum income. They want no risk. They don't want to touch their principal. I mean, when we're looking at retirement planning, we have to be realistic. We have to accept facts. There's tools out there available to help you accomplish your goals, but most people have to decide which goals are most important.
So know how much you'll need to retire. And when you sit down with us for your first one-on-one, no obligation, complimentary, no-cost visit, the first thing we're going to talk about is what are you going to need when you retire. You know, Christy, people get afraid to come sit down with a financial planner, financial person, because they think, oh, they're going to try to sell me something in the first 10 minutes. That won't happen when you come see us at the Presley Group. We're going to sit down, and for about an hour, you're going to do most of the talking, folks, because we want to find out what are your hopes, what are your goals, what are your dreams, what are your fears. Do you have a will? Do you have living wills? Do you need or have a trust? And more importantly, what do you need in retirement? We're going to shut our mouths for a while and listen to what you need. Only then can we determine how we can help you.
And we have a beautiful office. It's located in Denham Springs, Louisiana, right off of Veterans Boulevard. Beware of the traveling salesman. You know, we have a beautiful office. When you come in and meet with us, you're going to know we're here to stay. And really, I think the concern for most is that when they buy something out of their home from someone that doesn't ever invite them into their office is, number one, do they really have a nice place of business? Or are they going to be permanently in the business?
Do they have a foundation?
Yeah,
right?
and we get people that come in and meet with us because they have fixed indexed annuities that they've purchased through other advisors that never contact them once they're sold. And so we ultimately take over as a service agent, as a service to them. But, you want to deal with a company that you know is going to be there, you can feel comfortable with. And so I just recommend you stop by the office. We're on Veterans Boulevard in Denham Springs. You can give us a call. We'll give you directions. See what we're about. When you walk in our office, you get a really good feel for who we are.
Right.
Our phone number is 791-5773. We're not salesmen. We're here to make a difference.
Know how much you'll need to retire. Know how much you'll need for the retirement you like. So let's factor in vacations and trips and things. And then number 3, and this is the biggie, determine your tolerance for risk. In the article, Paul Merriman writes, this is probably the most crucial and yet the most neglected step in retirement planning. He says you don't necessarily need to speculate, you just need to find out and learn what's out there. Now, there are some people who come sit in our office and say, look, I'm 62 and I want absolutely, positively no risk at all for my portfolio. And we can help them because our tools never put your money at risk. Other clients come in and say, look, I want to take a portion of my savings, put it into one of your plans at the Presley Group so I know that money's safe and it's growing and I can draw from it if I need to. But with the other part of their money, they often feel comfortable managing it or having someone else manage it in the market. And that's fine, too. It's all based on your risk tolerance.
Well, and also, too, Matt, the thing is that people tend to believe that by coming in to meet with us, we're going to recommend that they put all of their money in the strategies that we use. But in fact, we're not going to do that. A balanced portfolio is going to provide us a safety net for good and bad times, but it's also going to allow us to have some money that we can manage more effectively in the market if we chose to.
Right.
Now I have clients that come in and say, no risk. Do not want to be able to lose my money. And for those people, even in that situation, we don't want to use 100% in a fixed indexed annuity because we want to make sure they have a liquid bucket of money
That's right.
that they could use for emergencies in the event that they need it for something. But, the reality is it's all about planning. And when we talk about the 10 steps to a perfect retirement, we can tell you those steps, but none of them are meaningful unless you take the first step. And so the first step is scheduling a complimentary visit so that we can sit down with you and help you determine what is your number? What is your income number? What is your goals? And let us help you accomplish your retirement dreams.
All right, so number 1, know how much you need to retire. Number 2, know how much you need to retire plus, that is, for the frills of life. And number 3, determine your tolerance for risk. We're going to come back in a moment and talk about some more of the top 10 steps to a perfect retirement. But let me again expound on the fact that when it comes to risk, when you work with us at the Presley Group, our tools, the fixed indexed annuity strategies we use, they remove all market risk. Now, there are some catches involved, right? Number 1, you don't get all of the gains of the stock market.
No, you don't.
You don't. You're going to not mirror the stock market, but you will certainly share in market gains. Look, 2013 was a great year. We saw plenty of double-digit returns for our clients. I met with a gentleman the other day, and his 2013 return was around 13%. Now, the true S&P was higher, but that gain that he made locked into his account. So our plans track the market. Interest is paid on an annual basis, and once that interest is earned, it's yours to keep. It's your new principal, and it can be perfect if you're worried about your risk tolerance in retirement.
And it can also be perfect, Matt, if your concern is income. Because let's face it, when we retire, we want to look at income. How can we turn this retirement bucket of money into income? And that's what a lot of the plans we use are really designed to do.
That's right. And so that's why we're offering this brochure, The Proper Use of an Annuity in a Retirement Income Portfolio. We call it our Annuity Owner Manual. If you would like it, beautiful publication, maybe 20, 25 pages. Good information there, not biased to any one company, just good generic overall information. Call and request that today. Call 791-5773. That's 791-5773. Say, I want that owner's manual you all were talking about, and we'll get that sent out to you. We'll be back with more of the 10 steps to a perfect retirement in just a moment. This is Your Money Matters, presented by the Presley Group. Our website is safemoneyplan.net. Safemoneyplan.net. I think our website sums up perfectly what we do.
It absolutely does.
We deal with your money, your retirement dollars. We always keep it safe from market losses. And more importantly, we fulfill step number 1 and 2 and 3 by helping you have a plan. So the website is safemoneyplan.net. You can find our Facebook page there and much more. And you can even online, if you would like, request your annuity owner manual. There's a place on there to send us an email. And also, don't forget, when you hit the website at safemoneyplan.net, there's a box there that says Ask Christy. And if you don't have time maybe to dash off an email, just go right there, click on the link, ask us a question about IRAs or Roth IRAs or whatever. We had a question earlier in the week. We'll get to that in a little bit. But you just send us the question, and within 72 hours, we'll give you a response to your question. The question we received was, and I thought it was good, and then we'll get back to the 10 steps to a perfect retirement. Someone emailed earlier in the week from the Ask Christy link and said, can I contribute to both a Roth IRA and a traditional IRA in the same year? Because they had a traditional IRA, and they're over age 50, so they had put $6,500 into their traditional IRA, because that's the most you can put into a traditional IRA.
Right.
$6,500 is also the most you can put into a Roth. So they wanted to know, could they come meet with us and open a Roth IRA and also put $6,500 in there? And the answer is no. The answer is no, and I had to explain to the person that the government says, hey, you can save either $6,500 into one or the other, or a combination of $6,500. You may put $4,000 into the Roth, but then you can only put $2,500 into the traditional IRA. And it's kind of sad because this person really wanted to amp up their savings some. So my recommendation was that they just save after-tax dollars so they could save even more. But if you have a question, send it to us through the Ask Christy link. All right, 10 steps to a perfect retirement, Christy. Paul Merriman wrote. Step 1, know how much you'll need to retire. Step 2, know how much you need to retire and then some, to have the thrill of traveling and things like that. Determine your tolerance for risk is number 3. And number 4, and this one's so good, base your decisions on what's probable. For example, he says, going out and buying lottery tickets, that's not a very sound investment. Over the past few years, the market has been wonderful. Last year, the most popular indexes gained nearly 30%, but that's abnormal. A much more realistic expectation for the next decade or so would be stock gains in the single digits. You're going to love this next line, he writes. Hope for the best if you like, but plan for less exciting returns. If your broker's creating a retirement plan for you and telling you, oh, we're going to do 8 or 9% till you die, be very wary of that. Be very wary.
And you know, Matt, the funny thing is that there's times where a potential client will come in to meet with us, and they've actually gone and met with different financial advisors, and they'll bring in their hypothetical illustrations that they've been given. And most recently, I saw one that was illustrating they would gain on average about 8% a year, and take an income from that and never outlive it. But the reality is that, you know, the stock market hasn't given us an 8% gain overall the last 10 years in a row. And that does make it shaky. In our workshops, we always talk about, you know, is it better for us to plan for the worst and hope for the best? Or is it best to plan for the best and hope for the best?
Yeah.
Well, no. We want to plan for the worst and hope for the best. And that's exactly what they're saying here.
Well, and the tools that we use, the thing I love so much, is when you sit down with me or Christy and talk about the fixed indexed annuity strategy, we're always going to be able to show you what is contractually the minimum guarantee. Can I tell a story? I love telling stories. Met with a gentleman. His name is John. That's his real name, John. And John sat down with me and said, Matt, I am behind on saving, and I want to start really making sure I'm saving and I have a strategy for when I reach age 70, okay, about 8 years down the road. Well, guess what? I was able to show him contractually how he could have X number of dollars per month minimum guarantee. So we can do better if the market does better.
Right.
But his contractual guarantee was X number of dollars a month in retirement money at age 70. And he said something to me the other day. We had lunch together. He said, finally, I'm not guessing. I have a true plan.
Right.
So if you're out there guessing at what your retirement income is going to be, stop guessing. Come sit down with us, because we take all of the guesswork out. Because we can show you contractually guaranteed with the insurance companies we use what is the best scenario and what is the absolute guaranteed worst that can happen if the market gives us 5 bad years.
Well, and the funny thing is that when we do our illustrations for clients, we always use worst case scenarios. We don't use best case. And,
right.
And often we see where people come into the office and they have brokers that they're working with never use worst case scenarios. They always use best case. When you're dealing with your retirement money, isn't it important for you to have a solid foundation? The plans that we use are going to give us contractual guarantees that are going to, you know, they're going to provide that steady guaranteed income. I call that mailbox money. It's laying the foundation. You know, let's think about it. We're sitting on a chair as we sit here and do this radio program. If this chair only had 3 legs, don't you think we'd be sitting kind of wobbly? Mm-hmm. Yes. Well, a retirement plan, in order for it to be successful, has to have 4 legs. It has to be a solid foundation. And a solid foundation is going to provide us that steady, stable income that we can count on, that's guaranteed. And that's exactly what our tools use. Our tools are fixed indexed annuity strategies. They're designed to give us guaranteed retirement income. And that's what we're looking for now, Matt. That's what we're concerned about. So many people are worried right now about a pullback in the market. Yeah. It's at an all-time high. They're really getting nervous. We're seeing a lot of people come in and say, look, I think it's going to take a turn. I just need to go ahead and capture those gains.
Yeah.
Because if they don't get out, they really haven't captured them. If they stay in and they wait for that pullback to come, did they really make that good money in all these years?
And speaking of that pullback, Mark Hulbert, who publishes the Hulbert Financial Digest. He'll be with us at the end of the show to talk a little bit about where he thinks the market's going. And there's this new chart that's out. It's been making the rounds on the internet about how the stock market over the last couple of years has almost exactly mirrored 1928 and 1929. We played that last week, and some people emailed and said, hey, I caught the very end of that interview, so we'll play it at the end of our show today. All right, let's move forward. 10 steps to a perfect retirement. Paul Merriman, who wrote this article, he kind of lumps together number 5 and number 6. Invest in asset classes likely to deliver over the long haul. And he talks about being in dividend-paying stocks and things like that. When we talk about the long haul, this is why Christy and I believe that our fixed indexed annuity tools are so valuable, because they are designed not for your short-term savings. They are designed for your long-term savings. It's kind of like the tortoise and the hare. I mean, you can go buy individual stocks if you want to, but boy, that's chasing the rabbit. If you're looking for the slow and the steady, like in Aesop's fable, that's how we can help you with something that over the long haul is going to deliver a return that you can count on as income.
Exactly, Matt. And these tools are not new. I get asked this question all the time. People say, Christy, why have I never heard about these products before?
Yeah.
Well, you don't hear about these products from your stockbrokers, because guess what, guys? That's not what they do. They invest your money in stocks, bonds, and mutual funds.
They're paid to keep
you
in the market.
They're paid to do that. But we are insurance agents, and fixed indexed annuities are insurance products. We trust insurance companies with our biggest assets. We trust them with our homeowners insurance and our cars and our lives.
Our life insurance.
You know, our lives. Why not consider using an insurance plan to help protect your retirement? They're not new. When I got in this business almost 17 years ago, these types of plans were available. They've just gotten better and better and better.
That's right. If you want to know more about what we do or schedule a free, no-obligation, one-on-one consultation, you can call us at 791-5773, area code's 225. We're right here in Denham Springs, 225-791-5773. Online, you can visit us at safemoneyplan.net. And again, we're offering this Annuities Owner Manual, the proper use of an annuity in a retirement income portfolio. And if you would like to get a copy of that, it's absolutely free. Just a good place for you to start learning more about what we do. That's same phone number, 791-5773. All right, number 7, we're talking about the 10 ways to a perfect retirement. Did I mention my perfect retirement would also be like a house in Louisiana during football season?
No, you left that out.
And then like a house in Hawaii in the winter, and then a winter house for like a month in Colorado. That's my perfect retirement.
Okay. Nothing wrong with dreaming.
Oh, but wait, hold on. Number 7, keep your expenses as low as possible. He writes, think of your portfolio as a sailboat trying to move forward, and expenses, that's the anchor that drags behind. Even if you have a great wind and a terrific crew, that anchor slows you down. The bigger the anchor, the slower you go. And what is the biggest anchor? Debt.
Yes, it absolutely is debt. But, you know, debt is not the only angle, the only anchor. There's so much more to it than that, Matt. When we think about expenses, let's talk about expenses in our retirement portfolio.
That's a good point.
You know, I can tell you, I see people that come in and think they're only paying 1% a year. And in fact, when they get their reports, their Morningstar reports and do their homework, they find out that they're actually paying 3-4% a year in fees.
He even writes that in the article. He says, avoid one-time expenses like commissions on mutual funds. In effect, they force you to start sailing back behind the starting line. How many of you out there know that sometimes your broker may put you into what's called a front-loaded fund? And all of that means is you say, okay, I want to buy this mutual fund for $5,000, only to find out there's a 5.5% fee to buy the fund. Now, I'm not saying you should or shouldn't buy the fund, but are you aware you're paying that kind of fee?
And I think that's what's important, Matt, is really understanding what fees you are paying. A lot of the plans that we use don't have any fees. And if they do, it's because you're buying a guaranteed income rider or maybe a death benefit. If you have a fee in a fixed indexed annuity, it's going to be typically less than 1%. Whereas our brokerage accounts, we see fees can be much higher than that.
Much
when
higher.
you include the management fee on top of 12B-1 fees, on top of front loads, deferred loads. And hey, we haven't even mentioned a variable annuity.
Well, let me mention that briefly. I didn't tell you this story. I forgot. I met with a couple earlier in the week. And they were preparing for retirement. They came to our Social Security workshop, and they said, we'd like to go over our Social Security plan. And they've got a couple of variable annuities they've owned for a long time. But they're concerned about the market. So they had put part of their money into the I think they called it the stable value fund inside of the variable annuity. Mm-hmm. And I looked at it, and it had a negative in front of it. It was negative 1.34. Mm-hmm. And I asked the client, I said, his name is Chris. I said, Chris, are you aware that that's a negative? Yeah, I wondered about that, he said, because it says stable value, so it's not supposed to go down. I said, it's going down because the fees in the variable annuity are actually costing more than the stable value fund is making. Phenomenal, right?
It is crazy the amount of fees that can be hidden within a variable annuity. And Matt, if I remember correctly, you asked that gentleman if he knew he was paying fees, and he was adamant that there were no fees.
Yeah, he didn't think so.
None. He thought there was no fees in that variable annuity.
Well, we learned otherwise. So just be careful and understand what you're buying.
It's just important for you to know the facts.
We're not saying fees are bad. What I think is bad is when you don't know what's there.
Exactly.
And the person who sold it to you didn't tell you. All right, number 8 in the top 10 things, the top 10 ways to a perfect retirement. Pay as little as possible in taxes. Isn't that like a gross understatement?
Well, I think that should say pay no taxes.
I like it.
I'm picking.
But here's one thing to think about. The IRS gives annuity special treatment. So I want to talk to those of you out there who are sitting with after-tax dollars, sitting non-qualified money, we call it, sitting out there in CDs making nothing. What little bit you're making, you get a 1099 on that. And guess what? Then you've got to pay taxes by the time you get in your car, drive to the bank, renew the CD, go pay the taxes, and get back home. You probably lost money.
Exactly.
But the way the IRS treats an annuity and our fixed indexed annuities is your gains are not taxable until you take the money out. Then you get something called triple compounding interest that happens. You earn interest on your principal, interest on your interest, and then you earn interest on the taxes you didn't have to pay. That's powerful.
It's magical.
Number 9, put your investments on automatic. We're running short of time here, but basically he says don't jump into and out of the market, into and out of. Well, the thing we love about our fixed indexed annuities, they are on automatic. We link you to the market. If the stock market crashes, you don't lose a dime. If the stock market performs well, you share in those gains. You may even have a guaranteed return, but it puts your retirement on an automatic path where you have a guidance that says when I get to X age, my plan's going to be there the way I want it.
And that's what people really want in retirement, Matt. They want to know that they don't have to sit in front of the computer and watch what's going on with their account.
Exactly.
If you would like to learn how you can put your retirement plans on automatic, give our office a call and schedule a complimentary visit to come in and meet with us. It is a complimentary visit. We're not going to twist your arms. We're going to simply give you a cup of coffee or a soft drink or a bottle of water, maybe a plate of fruit or some cookies, and sit and listen. And you're going to tell us what you're trying to accomplish, and we will know immediately if we're able to help you. If we're not, we're going to tell you that. We'll help lead you in the right direction. But most of the time, we are able to make a difference.
Our number is 791-5773. All right, last but not least, we're going to hear from Mark Hulbert in a moment. But number 10, the 10 steps to a perfect retirement, determine the best strategy for withdrawing money from your portfolio. This is incredibly important.
This is absolutely important. It's crucial.
A lot of you may think, well, I have no choice. I just have to pull my required minimum distribution out and I have to go spend it. We often recommend if you don't necessarily have to spend the RMD, maybe you take it and you buy a life insurance policy that then pays your heirs tax-free insurance benefits when you die. There's all kinds of strategies that can really help minimize taxes and give you the best return on your money.
Just like there's a lot of different strategies you can utilize in drawing your Social Security benefits. You don't know what you don't know, and you owe it to yourself to learn different options that are out there. You would be surprised how many people do not need the required minimum distribution that the IRS is forcing them to take out of their account.
Right. At age 70 and a half, the government makes you withdraw from your IRAs and 401ks and things like that.
So if you don't need that money, we can most of the time take that pool of money and turn it into a tax-free benefit, a very large tax-free benefit for your heirs.
It's a great way to help, build a legacy. Okay, those are the top 10. You can visit MarketWatch.com. Paul Merriman is the author of that particular title. And again, if you would like the Annuity Owner Manual, simply call us at 791-5773. We're going to come right back. It's all about the stock market. Where is it going? Mark Holbert from the Holbert Financial Digest will join us in a moment. This is Your Money Matters, presented by the Presley Group. Your Money Matters continues, presented by the Presley Group. Our website, safemoneyplan.net. Our phone number, 791-5773. Well, as promised, time now to talk about that eerie chart that shows 1929. Mark Holbert from the Holbert Financial Digest has the scoop. Oh, my goodness gracious. Has Mark Holbert stirred up a firestorm, or at least in part? Mark, the headline in your wildly popular article is Scary 1929 Market Chart Gains Traction. Tell me about this chart.
Well, yes, be happy to. Now, this is a chart, I should give some background, that I first featured in a column 2.5, nearly 3 months ago, in late November, early December last year. All it does is superimpose a chart of the Dow Jones Industrial Average over the last 12 months on a chart of the Dow back in 1928 and 29, right leading up to, of course, one of the worst stock market crashes and worst periods in U.S. stock market history. And so at the time, I have to confess, I interviewed a number of statisticians and market professionals who poo-pooed the idea that this had any statistical validity whatsoever. I'm now revisiting the issue because, believe it or not, over the last 2.5 months, the market has continued to follow the correlation that was first at least identified in that chart 2.5 months ago. So it's not as easily dismissed now as it was then. If anyone thought that it was simply a shameless effort at sort of retrofitting the data to make it look like it was matching some previous period, and of course you can always play that game. You can always find periods where it looks like the squiggles of ups and downs and so forth are matching each other over different periods of time. The fact that it has continued to fairly closely follow the same script gives additional credence on the one hand, or if you want to be a skeptic, you can say, well, it still has no validity, but it's not as easily dismissed as people were doing 2.5 months ago.
I got to tell you, Mark, it's uncanny. And this thing has blown up on social media, and it's one of the most shared items ever at MarketWatch.com because this is radio. I can't show you, but if you go to MarketWatch.com and just type in Mark Holbert or 1929, you'll find it. It is eerily similar, and what we're seeing is if this thing plays out perfectly to form, then the market will rally through the spring, and then in the summer will be the great crash of 1929, right?
Well, yes. Now, I do want to say that, and first of all, I myself am not a chartist or a technician. Those are the terms that Wall Street applies to those who look at chart patterns this way. What I do is track the performance of several hundred advisors, some of whom do look at this and have good track records. So I want to give them their day in the sun. And the two technicians that I quote in the column who actually deserve the credit for noticing this parallel, mainly a guy named Tom McClellan. He has a newsletter called the McClellan Market Oscillator. And then there's a fellow that indeed he in turn gives credit to, a guy named Tom DeMark, who has a well-known institutional service that looks at chart patterns and has a number of institutional clients. And what they will say is that the correlations don't have to follow each other in terms of magnitude. It's more the fact that the directions of the ups and the downs more or less follow the same. They're both marching to the beat of the same drummer, so to speak. And so what they would be the first to say and have said to me is that even if this correlation were to continue, and of course that's a big if, that doesn't mean that we're going to have a 50 or 60% market crash. It just means that we're going to have some significant losses and turmoil in the market. So I want to be the first to stress that a correlation like this, even if it continues, does not have to guarantee that we're having another crash. On the other hand, I don't want to sugarcoat it. It does mean that we're in for some real rocky periods over the next several months.
Our guest is Mark Hulbert, Hulbert Financial Digest. You can read his stuff online at MarketWatch.com. Mark, we're not math geeks, but does this chart take into account the fact that the actual number on the Dow was, of course, significantly lower than the number we're dealing with now? So the magnitude of the peaks and the valleys is not necessarily the same. I think you may have already said that. It's not so much the exact numbers, it's the direction, correct?
Well, that's right. And again, it depends on what kind of a chartist or a technician one might be, and in terms of how you might answer that question. I will say that the statistics behind it are such that it doesn't matter so much the magnitudes, but rather the directions of the squiggles that leads to some impressive statistics that measure the degree of correlation between the two series. So, again, it was one of those things that when I was first wrote about it in late November, early December, it was one of those ways in which people were able very condescendingly to dismiss the correlation and say, well, the chart magnitudes are entirely different, so therefore it has no validity. But it turns out, I guess my major plea that I think I try to reiterate in my column this week is that we may want to end up dismissing this. I don't want to prejudge that. On the other hand, we can't so easily dismiss it on the grounds that the magnitudes are different or that it's a shameless retrofitting of the data to match some prior period. Both of those charges don't have a lot of force right now, and I think we need to squarely face either it means nothing because we don't think charts ever mean anything, A, on the one hand, but if you don't believe that, then we're going to have to at least open the possibility that the market is playing out some sort of pattern here that bears very close attention.
Do you think this market is overbought? Do you think the price-to-earnings ratio, for example, on the S&P is out of line?
Well, that's right. Now, again, I should always qualify what I say because what my main job is tracking the performance of the people who do think they know the answer to that question, as opposed to myself claiming that I know the answer. On the other hand, that's never stopped me from offering an opinion and won't now either, and that is I do think that valuations are stretched too high right now compared to any market norm that you want to look at. Again, it depends on any of a number of issues on how you define valuation. One of the most popular is a ratio of the price to the earnings that corporate America is able to produce. The price-earnings ratio, again, is a very popular measure, and some people look at forward earnings, some people look at trailing earnings. You can come up with all kinds of complications, but if you do an apples-to-apples comparison, I think it's hard to claim that the market is fairly valued right now. I think we're either moderately or even more than moderately overvalued right now. And coupled with the fact that we've gone now for several years without even a 10% pullback, and history suggests that 10% pullbacks in a bull market are entirely healthy and normal. And in fact, I think the statistics show that on average you get a 10% pullback once every year. And we've now gone, I think it's, you have to go back 2 or 3 years to find a 10% pullback in the market. The pullback that we had in late January, early February, again, depending whether you look at the S&P or the Dow, measured around 6%.
Mm-hmm.
And that was scary enough. Boy, it got a lot of people's attention, but nonetheless was only about half as big as what is otherwise thought to be normal. And I think the problem with this market, above and beyond the valuations, which I think is problem enough, is that when investors who we just like all of us, we have short memories, don't remember that a correction is normal. Then when we do start getting something like this, they can start running for the hills very, very quickly and think the world's coming to an end when, in fact, it's just an entirely normal pullback.
Our thanks to Mark Hulbert, Hulbert Financial Digest, and MarketWatch.com for the great insight. By the way, this has become one of the most read and most commented on stories ever at MarketWatch.com. If you visit MarketWatch.com, just type in Mark Hulbert, Hulbert, and his latest article about this eerie similarity in the chart movement between now and 1928-29 will be right there on the website. You got to see this chart for yourself to believe it. It's wow. It's very interesting. And so the question becomes, like Mark was saying, is it just a chart? Does it mean anything? Well, certainly you've got a plan, right? Plan for the worst, hope for the best. It's kind of the motto we live by at the Presley Group in helping you prepare for a financially secure retirement in any economy. So if you're closing in on retirement, or if you're already retired, give us a call. Let us show you how the tools we use, the fixed indexed annuity strategies, can protect you if this chart does come to fruition, so that you don't put your principal at risk. And if the chart's wrong and the market keeps going up, hey, great news. You'll share in those gains and create guaranteed income. To schedule your free one-on-one consultation, call us at 791-5773. That's 791-5773, or visit safemoneyplan.net. Back with more of Your Money Matters in just a moment, presented by the Presley Group.